Welcome to another episode of Good Value by Antipodes.
It's Alison Savas, Client Portfolio Manager with you once again. Well, another quarter is behind us, and as usual, in this quarterly market update episode, we're going to be analysing the state of the markets and Antipodes' bigger picture views on global equities and portfolio positioning. Joining to do just that is Antipodes CIO Jacob Mitchell. Welcome back to the podcast, Jacob.
Thanks, Alison. It's great to be here.
Jacob, in this update, we do want to discuss the risk of policy error from the major central banks and Europe's looming energy crisis. But first, let's talk about the state of the markets through the second quarter. Global equities have fallen 16% this year to June 30, as central banks set their sights firmly on reducing inflation, despite growing concerns around economic activity. Now, the last 20 years have really been characterised by falling interest rates and inflation, low volatility around GDP, and where the Fed put came into play at the first sign of asset price volatility. But today, we have the Fed and central banks broadly in the West tightening as economic activity slows, and we have rising inflation. So is it fair to say we are now in a fundamentally different regime?
Look, Alison, there's quite a lot to unpack there, but yes, I think broadly, that is correct. Our base case remains stagflation and far greater volatility in nominal GDP growth outcomes to what we've been used to. But in the shorter term, a slowdown in economic activity or even a mild recession in the West can probably be offset by a stimulus-driven recovery in the East. So we should be able to avoid a global hard landing. You mentioned inflation. On the inflation front, regardless of whether inflation has peaked, there are some, it is still materially above the Fed and the ECB's targets, and we continue to see, for example, wages, rent, food and energy prices. There are these structural elements, and that, I think, can prevent the Fed from, sharply reversing interest rate policy or QT. So in this next slowdown, we're going to see a shift towards, I think, a lot more fiscal activism. It really started with the exceptional Trump tax cuts and away from the, just passive outsourcing of economic policy to central banks via QE and asset price stimulus that we've seen in the last couple of decades. We expect the stimulus to focus on longer-term investment areas like decarbonisation, tech and supply chain relocalisation, infrastructure. However, look, in the short term, governments are grappling with the cost of living crisis in the West, which will put further pressure on, I think, fiscal positions. So stagflation is our base case, but the range of outcomes around economic activity and inflation are very wide. And look, most importantly, I think just expect greater economic volatility, which will require, I think, a contrarian mindset to navigate in terms of the markets.
And I think the question that just about everyone seems to be asking is, do you think we've seen the bottom?
Look, the Fed has sent a pretty clear message to the market that its primary focus is to fight inflation, and the market is pricing in a Fed funds rate of around 3.5% by the end of this year. As discount rates have risen, the MSCI equity has fallen to around 14 times forward earnings from where it started at around 19 times at the beginning of the year. So look, equity markets have definitely reset. Arguably, the US equity market is pricing in a mild recession, whereas Europe and China are pricing in something much worse, arguably closer to a hard landing. Also, credit markets are really priced for a recession broadly across the world. US and European high yield spreads are already wider than where they were at the end of the last peak in the policy rate in late 2018. And we're only 3 months into the current tightening cycle. The credit market is saying that Western central banks have probably already over-tightened or China has been too slow to loosen policy. But, markets rarely go down in a straight line. There will be bounces along the way, and especially if we get some good news out of Europe or China, and we want to be positioned for this. Sentiment has arguably capitulated a lot more than earnings. So, the equity market may bounce even as earnings, start to reset downwards, simply because sentiment is so weak. Further, you've got forward inflationary expectations have started to fall, and hence there's probably a point where the market will start to price in, a Fed pause. So, for now, we're comfortable with our net equity at mid to high 70s in the Antipodes Global Fund, having closed out parts of our short book and tail risk hedges, which performed well in the recent dislocation. Now, given the level of economic uncertainty and higher discount rates, I think we have an opportunity to reload. We will have an opportunity to reload some of our shorts and on the long side, the market is going to be more focused on valuations than it has been over the past sort of decade. Investors arguably just need to be more selective in a backdrop of stagflation. In terms of equity, different styles, growth in value styles are more likely to become correlated in this type of environment, just as bonds and equities have continued to be more correlated. Finally, we expect equity markets will become a lot more, stock specific rather than driven by style, and tight credit conditions will see the market continue to favour these more resilient businesses with stronger balance sheets.
Now let's talk about policy error. It's a key risk we've been talking about for a while now, whether that's the Fed or the ECB tightening too aggressively into slowing economies, or China waiting too long to stimulate. We know that interest rates are a blunt tool. They will intensify any economic slowdown without addressing inflationary pressures that are driven by supply side issues. The ECB is, arguably in an even more delicate position than the Fed, isn't it? Given that risk around economic activity is higher with a backdrop of war, and food and energy prices are particularly elevated. And further pain is likely as Europe strives to decouple itself from Russian gas. So can you take us through your thoughts on the macro environment in Europe?
Look, Europe always sort of seems to, catch pneumonia when the rest of the world catches a mild flu. The ECB is probably, is going to have to take a softer approach, I think, into rate hikes and to QE relative to, into QT relative to the Fed, because the risk of a recession is higher. The ECB will be mindful, that aggressive hiking of short-term rates will also put pressure on peripheral Eurozone spreads in countries like Italy, which has has this greater dependence on gas, and government debt to GDP is relatively high. On the fiscal side, spending will focus on helping households with high costs and supporting alternatives to gas.
And what about the energy crisis itself? It could really intensify in the next six or so months as winter hits.
That's right, and there's been a few developments on that front. Gas is once again flowing through the the Nord Stream 1 pipeline from Russia to Germany, as at the end of last week. The pipeline was operating at 40% utilisation, but fell again on another turbine maintenance issue. Putin remains unpredictable, to say the least, but at the end of the day, gas accounts for almost 7% of Russia's GDP, and this could go to zero next year in the event of no Russian flows. So there is self-interest in Russia's part to maximise revenue today through maximising price through low volumes. But you're right, on our analysis, Europe's key energy pinch point is this next 6 or so months, with critical point being that Europe needs to build sufficient gas stores to get through the winter. To put some numbers around that, Russia historically accounted for a third of Europe's total gas supply, and the European Commission has directed its member states to focus on filling storage ahead of winter, and to cut gas usage by 15%. And in the immediate term, this could see some countries reducing heating and auctioning supplies to, let's call it, the most economically value-added parts of manufacturing, as well as switching fuel sources where it's possible. Now, if we go back to pre the war, Russia was historically pumping gas at a rate of around 3.5 BCM per month, and on our analysis, if Russia continues to pump at around 1 BCM, sorry, that number is per week, and if it keeps going at a weekly at about 1, from 3.5 down to 1, then Europe may be able to avoid having to curtail demand via plugging that gap, the 2.5 BCM per week gap, with LNG. But there is this risk that Russia delivers substantially less than 1 BCM per week, which is a critical level below which you start seeing significant supply-demand imbalances at the most vulnerable countries like Italy and parts of Eastern Europe, around Poland, the Czech Republic, Austria, which lack the pipeline connectivity to receive LNG. So in the event of no Russian gas, a 15% cut to European demand could mean up to a 30% cut in demand in places like Italy, and 50 to 70% in Eastern Europe, because these countries are overly dependent or landlocked overly dependent on Russian supplies. So even if Russia keeps delivering at 1 BCM per week and we avoid the hard demand curtailment scenario, attracting so much LNG flow will come at a high price, and obviously at a cost to Europe. Russian gas was historically delivered at closer to $6 per MBTU, and on our analysis, higher gas energy prices and more LNG could be a 2 to 3% cost to the European economy, and industrial users will likely bear the brunt of this. So a lot to take in, but if we look to 2023, Europe will get some additional pipe gas from Norway and Algeria, and more regas capacity is being built to allow higher LNG imports for the bloc, especially in Germany. Now, if you think about the global LNG market, LNG prices today are closer to $40 an MBTU. So, and European gas prices are closer to $50 an MBTU, which is meaningfully higher than long-term contract prices that the likes of Japan, China, Korea have with major LNG exporters. So at current prices, there's a very strong incentive for those countries to sell their contracted volumes to Europe rather than taking delivery. Japan is already ramping up its nuclear to generation to offset its reliance on LNG. China can use more coal, and Korea more fuel oil, which will allow these countries to divert some of their LNG to Europe. Now, the issue here is that these are long-term joint venture contracts, and the suppliers have power. So, but even assuming part of the profits on this sale will need to be shared with the Middle Eastern producers of LNG, the economic incentive that is there for that diversion to take place. Look, lots of moving parts. It won't be easy for Russia to replace Europe to replace Russian gas, and it will be costly, but it is possible. The tail risk remains that Russia stops pumping gas completely and hobbles the most vulnerable countries. Putin definitely has a powerful card to play if he feels increasingly cornered by the West. So we need to monitor that risk, very closely.
Now, some of our listeners will know that our global portfolios remain overweight Europe. So how are you thinking about this exposure?
This uncertainty is why European equities are currently priced at just under 12 times forward earnings, compared to closer to, say, 16 times over the last 5 years. On a 1 year forward PE basis, European equities are almost 30% cheaper than European equities are 30% cheaper than US equities, whereas over the last 5 years, Europe has typically traded at let's call it a 16 to 17% discount to the US. The market is pricing in a tough scenario around energy and recession. If Europe can muddle through, then European equities look cheap. Our global portfolios have around 25% exposure to Europe, but our exposure is focused on multinationals such as Siemens, SAP, Sanofi, Airbus, leading franchises that generate their revenue and profits globally. They aren't just dependent on the European economy. And they are available at a discount relative to US or Asian peers because they are simply listed in Europe. Look, in terms of the domestic-facing exposure we have to Europe, it comes in three categories. First, we have our exposure to utilities, which have, essentially, a key. Number one, they're relatively defensive. Number two, they have a key role to play in greening the grid and decarbonising the power sector in Europe. This energy crisis should see Europe accelerate its investment in this area, so we're relatively comfortable there. Next, we have our exposure to European financials, like relatively pretty high quality banking franchises in UniCredit and ING. We have just over 3% across those two positions. They are priced at distressed valuations despite both having 20 to 30% of market cap in excess capital. UniCredit has a planned and sufficient capacity to comfortably return over 80% of its market cap in the next 3 years, and ING has a plan to return around 2/3 of its market cap via a mix of dividends and buybacks. And we're managing the risk around these positions via sizing and tail risk hedges. And finally, we have Tesco, which is taking share as grocery shifts online and has a plan to protect its profitability via passing on some of its high costs to end customers and cutting its own costs. And it's priced at half the valuation of similar businesses like Walmart in the US and Woolworths in the Australian market.
Let's turn to China. We see policy error there as a key risk as well. Economic activity continues to be weighed down by the policy tightening from 2021, as well as the recent lockdowns. Now, policy has been loosening, but at an incremental pace. Do you think we'll see more stimulus?
Yes, we will. Look, the Communist Party will do whatever it takes to restore economic stability, and as an internally funded economy, with excess savings, they do have a lot of flexibility. In the short term, it looks like the worst of lockdowns have passed, which is a positive. Commentators who track this closely suggest that 4 to 8% of China's GDP remains in lockdown, but that's fallen from, let's say, 25 to 35% in April. And we can see, the data from the data that mobility is really increasing, whether that's subway movements, airline, intracity movements, and cargo freight. On the COVID front, mass testing centres have been rolled out at large populous cities so that infections can be identified quickly and to cut that transmission chain quickly, which can help contain future outbreaks. This provides, I think, a pathway for China to continue to ease restrictions while there's been progress towards also sort of improving new vaccines, including a domestic mRNA version and a locally produced version of the BioNTech vaccine. Our view remains that a sustained easing in lockdowns can act as a catalyst to increase the pace of stimulus, which can boost, boost economic activity going into 2023 and potentially offset, the slowdown that we're seeing in the West. I think investors need to be mindful that China has run tight policy relative to the West, and so has a degree of fiscal and monetary flexibility. Retail sales, are down just over 1%, 1.5% this year after slowing meaningfully last year, and property sales have fallen more than 20% over last year. But China doesn't have the inflation issue that is forcing policymakers to tighten in the rest of the world. And that's, I think, just an important difference. And we're starting to see the Chinese banks provide support to the property sector, and we're seeing interest rate cuts, and we think you'll start to see additional stimulus, which will focus on a combination of consumption subsidies for lower income households, and investment stimulus focused on China's decarbonisation agenda.
And how big a risk are the recent headlines around Chinese home buyers refusing to pay mortgages on unfinished apartments. Can this trigger a systemic risk in the banking system via rising non-performing loans?
Yeah, look, it's an important it's an important point in the sense that the simple answer is we don't think it will, but our listeners need to understand that the way the market operates in China is different to the West, and that is you have to take your mortgage relatively early in the construction process, and that mortgage, a large part of that goes to the developer and actually funds the build. So you can understand, on the margin, if you're waiting for your apartment to be delivered and it's been delayed and you're paying your mortgage, you'll be pretty upset. So, but just to sort of quantify it, there is, what we've seen so far across certain developments, there's roughly, 300 unfinished projects, and taking a sample of some of the major cities, delayed projects account for less than 1.5% of total projects under construction. So even if we assume this spreads nationwide and halts projects of all distressed developers, which is an extreme scenario, we think the impact is around 2% of outstanding mortgages, or 700 billion RMB. China's banking system has around 10 trillion RMB in excess capital. So at this stage, it can cope. But there is pressure on the government to sort this out. And, we will continue to follow the situation closely.
And aside from central bank policy error and Europe's energy crisis, are there any other tail risks you're monitoring?
Yeah, look, it's a good question. Given the interest rate cycle, we're watching any economy with elevated household debt and elevated property prices, so where disposable income is going to be very sensitive to floating rate mortgages. So that includes Australia, but also Scandinavia, the UK and Canada. We're also thinking about implications of a potential unwind in credit for debt-dependent private asset markets. Corporate credit, the average state of corporate credit has deteriorated over time. Buyout valuations are likely really facing mark-to-market hits as asset valuations reset and funding costs are rising. Any credit rating downgrades will impact financing availability and costs in the leveraged loan market. And these bonds loans tend to be owned by pension funds and life insurance companies rather than banks, which do remain pretty well capitalised in most regions. So the systemic risk lies in very different parts of the balance sheet than it did in the global financial crisis.
Okay, Jacob. Now to sum this all up, given these broader market views, where are you seeing opportunities, and how are the global portfolios being positioned as we move into the third quarter?
Yeah, look, we continue to favour market leaders that are in a better position to manage in this, let's call it, tougher or more volatile environment of slowing growth and high inflation and let's call it a rapidly evolving landscape. Multiple dispersion still remains elevated and at the market level, so we're still finding opportunities across regions and sectors. The value index is heavily skewed to financials and away from tech. And with multiple dispersion so high, I don't think you have to wedge to the traditional cyclical value sectors to build a pragmatic value portfolio. We have 30% long exposure to emerging investment cycles across decarbonisation, infrastructure, connectivity and compute. And the extreme sell-off that you've seen in the tech and growth complex, whilst we're still underweight, US mega cap tech and internet, we are starting to find some opportunities on the margin, particularly around ERP or enterprise resource planning software, database, robotic process automation. These are all longer term trends which we think are going to be more resilient as a part of the move to the cloud, it's all about a cost saving and a productivity decision, which ultimately, even in a tough economic environment, is going to happen. We remain sort of underweight the US domestic cyclicals, which we think will bear the brunt of the current cost of living crisis. Look, we've also pared back some of our overweight to the US natural gas producers, which have been a meaningful contributor to recent alpha. And for now, US gas remains captive. Over time, they will build out LNG export capacity. Look, we will look for re-entry points because we think these companies have a critical role to play in the longer-term energy transition and ultimately are going to be part of the solution for Europe. Look, in Europe, the broad focus of the portfolio is multinationals. And if Europe can muddle through without falling into a deep recession, then these stocks do look cheap. We've rotated some of our exposure in European financials into US financials, given the recent sell-off in US banks on macro concerns. But at current prices, the market appears to be pricing in an overly pessimistic scenario around credit risk in the US, given corporate household balance sheets look okay and unemployment is still low. The US is arguably further through the tightening cycle relative to Europe, and US banks generally get some benefit from rising yields. With regards to China, the timing around a reopening is still unclear, but the situation is moving in the right direction. The market isn't pricing in reopening, policy change, or the potential for more stimulus. China does have fiscal and monetary policy flexibility, while the West is slowing and tightening. Once China moves through this lockdown, there will be a real divergence, I think, between the economic cycles relative to the West. And today you have an opportunity to invest in some great businesses at attractive valuations, which will be relatively non-correlated to Western economic outcomes. So we're comfortable with our exposure. It's part of our process to look for clusters of non-correlated alpha, and that's what we see in China, and very non-correlated to the broad ACWI benchmark, which is so dependent on the Western economic cycle. It's focused on domestic exposures that are going to benefit from a combination of a cyclical rebound, but also structural consumption trends. And finally, just in regards to the US, it's still our single largest exposure at roughly 40% long. And whilst we've been overweight global cyclicals in that market, given the correction in both the growth and the domestically exposed US equities, we are finding more opportunities on the margin to deploy capital.
Thanks, Jacob. Look, we've covered a lot of ground today, so we'll have to wrap it up here. But as always, thank you very much for your time and your insights.
Yeah, thanks, Alison. Thanks for the insightful questions as always, and thanks for the opportunity to provide the update to our listeners.
For any further information on Antipodes, head to our website antipodes.com, and you can also follow us on LinkedIn or Twitter. In our next episode, I'll be speaking to the CFO of German-listed energy giant RWE. So make sure you subscribe so you'll be notified when that episode goes live in a few weeks' time.
Please remember this content is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives or needs. You should seek professional advice before making any financial decisions.